You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com, and co-hosts, Uncle Mike Tusaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionPit.com.
Liquidity providers roll the dates forward, which shows up as lower implied volatility. That's on Friday. So when you come back in on a Monday, since implied volatility is now running at a more approximate date than to where we actually are, the implied volatility looks like it shoots up, so the VIX records that as a jump. As it starts to melt during the day, that's actual implied volatility starting to decline again, or liquidity providers, again, forward rolling the date to compress volatility or compress option prices because they're trying to take those vacation days out of the market. And that's what they did today. And then I think it looks like we had a little bit of a sell-off at some point during midday, kind of enough to drive volatility up a little bit as, VIX, S&P 500 moves down, VIX moves a little up. And then it looks like it worked really hard to close to the end of the day at near unchanged. So that is the tale of the VIX today.
Most definitely, because I'm looking at this, and the short call that I am in, I going into today, and also still even at the end of the day, I didn't get out of it. I was short the November week 4, expiring this Friday, 210 call on SPY, and just looking at the volatility on that one between Friday and today, it got royally sucked out of it. Which is obviously a good thing, being a short call holder. But would that also be something to do with the dates rolling forward, would you say?
Absolutely, yep. So what they do is, because implied volatility is trying to tell you what the options are doing right now, what the implied volatility of the options is right now, because they're backing out what the current price is, they're rolling that through the model, through the iterations, and then they're telling you what the implied volatility is. So the model knows today's date is the 23rd, right? That's the input date that we're using, right? So it's calculated. You can generate a theoretical value, though, on any date you want. I could generate a theoretical value on tomorrow's date, or the next day's date, or the next day's date. And if you keep all the other inputs the same, if you keep moving the date forward, what's going to happen to the implied volatility, what's going to happen to the option premium, right? It's going to keep going down, down, down as you get closer to expiration. However, implied volatility, when you do that calculation, it's using today's date. So you have a theoretical model generator using a forward date, and you have implied volatility, which is let's just call it, it's a different fruit in the same category. Implied volatility is calculating off today's date, what's happening right now. So what happens is your options, every time what's happening with implied volatility is it keeps, for today's trade date, it keeps declining because the premium in the option keeps declining because the liquidity providers keep rolling the date forward, which shows up as lower implied volatility. So you had after Friday, right, when they dropped when they roll the weekend forward, also knowing that they have a holiday shortened week. You open today, and everything is kind of as of this morning's trade date. As the day rolls on, liquidity providers start to forward roll the date again, which is going to compress premium again. So you should have seen your call prices go down, right? Now, implied volatility is going to start going down with that, because implied volatility is looking at today's trade date and saying, wow, if the stock's not moving and our time is stuck, right? Because implied volatility, when you do that calculation, just sees time as being stuck. Now all of a sudden, everything is dropping. So the only thing that can really be changing as far as implied volatility goes is I have to generate a lower implied volatility number for this premium that keeps decreasing. And then you get to some point where, okay, we've taken enough time out of the options, considering we still have a couple days left to trade, so that forward roll stops, implied volatility stops going down, and then, the market actually started to drift down a little bit, and a little bit of juice got pushed back in the options, just because that's the actual other effect of liquidity providers pushing the implied volatility up just a little bit. So you have time kind of on one side of the fence doing most of the work, and then implied volatility kind of catching up. And there might have been a slight uptick in it for a while today, but with VIX only up 15 cents, that generally means, because of the weekend, all that juice and got sucked out of the options, and it did not return.
That's a very important answer, because I think just on our show, a lot of our listeners, and I've heard this in the past, I know you've heard this in the past from just retail traders with which we've run into, is that, I want to sell premium over the weekend so I get 2 free days of time decay. And I'm guessing you, going out on a limb, and you would agree that would not necessarily be, selling premium on a Friday might not be a bad idea, but if you're doing it for that reason, would you agree that would be a foolish thing to do typically?
Typically, yes, it would be a foolish thing to do, because you're not really getting the weekend's premium. That's the problem. They've already taken it away from you. So when you get back in on Monday morning, you'll only get a fraction of what you thought you might get. It's quite annoying, actually, when you first look at it that way, but that's what it is. What they did take out of it today was future premium came out. The actual VIX futures did drop actually a lot more than I thought they would today. We got a pretty substantial drop in volatility at the end of the day, and they're still crushing it. Actually, Mark and I talked about it this morning. He just thought they'd keep hitting the future with the D dropping below 17, and almost did. So he was definitely right. I didn't think it would drop so far so fast, but that is the market being, or at least the volatility traders, satisfied with the premium they have and everything right now. And you've got, what is that about? Yeah, you got $1.40 in premium in the January future. It's about normal. Or I'm sorry, in the December future. That's plenty for the amount of time we have left to expiration. So that's what we got.
That it is. What other things may have been catching your eye today in this exciting road to nowhere?
That's what we're going to call the show, the road to nowhere.
But the exciting road to nowhere.
The exciting note. 2 things. We looked at CMG. I guess it was down a couple $100 over the last few days on the E. coli scare or something like that. I was trading the 6 handle not very long ago, and I think, yeah, it was trading 614 on Thursday last week, and the low on Friday was 536. So we did look at that as a potential play, and it backed off around $7 from where we were talking about it. And I thought that was kind of interesting. And then some stock that actually doesn't trade options, K-Bio, up $21. It was an $18 stock that was up $21, something like that. Huge short squeeze of monumental proportions in this thing. It was just a $2 stock a couple of days ago. $2 to $39.
Wow.
I think it was kind of engineered by some blogosphere guy, and I think some crowdsource funding guy wanted to short it, so he raised money to do it. There's some kind of story there. I wish I knew what the whole story was, but it very well can go right back to zero again. But right now, since nobody can borrow it, they all have to cover it, and it's become a massive, yucky mess for somebody. Not me, because if it doesn't have options, I don't care.
Wow. So that's actually one of those ones to where you get all those rip-off emails to where people say, buy this penny stock, and this time it actually worked out for somebody.
Exactly. And it has something to do, too, with the guy that – remember the guy that bought the cancer drug that jacked up the prices?
Yeah.
He somehow is involved with this. I don't know if he's the one that owns it, or he tried to engineer the squeeze or something. But it worked for somebody. But there's somebody definitely on the not happy end of that particular stock. So that's the problem with the new short sale rules as they are right now. People are starting to figure out how to manipulate them, and unfortunately, it's not the last that we're going to see of that.
No, not at all. Not at all. Well, we've always said on this show how we need more regulation in everything with which we do in life, right?
Yes, exactly. We need a lot more regulation. That's I was just laughing for a second.
Nothing wrong with that.
Yeah, exactly. So those were, I mean, as far as everything else went, a lot of the, Apple pulled back a little bit. I think there was some profit taking. Of course, Amazon is on its way to 700. It looks like Google was up $10 at one point today and sold off. So. Yeah, I think a lot of stocks are just taking a little breather. All that, we'll just call it the QQQ stocks, just sort of stopped going up today. So that's kind of what we have. It wasn't a very exciting day. There's not a lot of people, less and less people will be on the desk as the week goes on. And it's generally, I always thought it was a quiet day for the market. I usually would leave on a Tuesday with minimum positions. And just kind of get ready to see what would happen between next week and Christmas. So
yeah, and the other thing with retail sales, the most recent retail sales, we've talked about this on the show in years past about how really irrelevant they are this time of year until the results from Black Friday come out as well.
Right, and that will be coming. And there's a bunch of companies that are going to close their doors for Black Friday, which I thought was kind of interesting as well. I wonder how that's gonna, clearly the sales are going to be less than they were last year. So, I find that interesting in the least.
I do too. That's one where I think that maybe the theory behind that would be that you're trying to grab a headline to get people to say, oh, these guys are really good. They're not like those capitalist pigs that are open like Walmart on Friday. They're good guys. We should support their business on Monday and buy something on Monday from these guys.
Or Saturday.
But I have to be honest with you. I really don't see that working, because if I really wanted to get my 42-inch LED TV or whatever, and I felt it was a good deal at Walmart at 2 p.m. on Friday, or for some people 4 a.m. on Friday, whatever, then by all means I'm going to do that.
I think that makes sense to do it, but there'll be something. There's always a little backlash of people saying, "Well, we want to be home with our families. It's Friday," and I see that. So Black Friday became kind of a thing, and I don't know. Since I don't really participate in it, it's hard. It's hard for me to have I don't really have much of an opinion on Black Friday, since I think it's great for other people.
I would agree with you on that one. And since the high school football team I'm coaching is not in the state championship this Black Friday like we have been in years past, I don't even know what the heck I'm going to do, so I'll figure out something.
I'm sorry to hear that. I'd much rather hear you, coaching a state championship football team. That's got to be fun.
Yeah, we wanted Aurora Christian High School. We wanted a couple of years ago in 2011 and 2012, but had a couple of years to where we've made the playoffs. This is the first year we didn't make the playoffs, but we've still had some good runs at it, but still not like the 2 glory years we had of years past. But we think next year could be a big year for us.
Oh, good. Well, I will look out for what is it? Aurora Christian.
That it is.
All righty. I wish you the best.
Thank you, sir. All right. Moving onward as we go beyond our talk of high school football for right now. Did you happen to see the big merger from Pfizer and Allergen?
I did. We even covered some paper on that from not long ago in, I guess, the Odd Block. There was big sellers of straddles, actually, and then buyers of put spreads, which I couldn't understand that trade at all when it went up. It doesn't look like it worked particularly well. But what do you think that I think all this healthcare, health law, you're going to see a lot more of this consolidation?
I do too. I mean, here's the issue with which we face. Obamacare was something, I don't want to get too political on this, but with Obamacare, what is happening this year is a lot of premiums are going higher. In order for Obamacare to get passed, premiums needed to look somewhat the same. But the price tag comes into play a couple years later. For example, yes, I am a representative of RCM Wealth Advisors, and everything I say on the show is true. However, for tax purposes, I am also my own corporation, and I have to have individual insurance on myself and my family. Now, granted, my wife just recently got a job as a nurse practitioner, and so through her company, we can get family health insurance through her company. But with that being said, I was just kind of looking around at individual insurance policies, and so if I were to get the same insurance for the coming year, my health insurance would go up 10%, and the deductible would be reduced it would be a much higher deductible, and basically I'm paying a lot more for a lot less insurance. And so I think that I'm not the only one in that situation because of the fact that a lot of Americans work for small businesses. And because a lot of Americans work for small businesses, they're going to be in a similar situation in that not necessarily just if they're getting individual insurance, but if they're not getting a very group beneficial rate because the employer that that they work for does not have millions of employees, then the small business that they work for that has maybe 10 employees is going to be in a similar situation. So because of that, what that's going to do is everyone's scrambling and trying anything with which they can to cut costs with health insurance at this point in time. And even in the drug space, there's going to be ways with which there needs to have the insurance companies cut costs to deal with new regulations, and they're going to need to join forces. So from my experience and my opinion on what's going on in the healthcare space, I could see a lot more mergers happening over the course of the coming years.
Yeah, because they're going to have to just be bigger to deal with the government, with cost savings, everything. Everything's going to have to just get less somehow. But the problem is I don't know if the consolidation is actually what you want. All of a sudden you have lots of smaller players, and now you have a few big players. So I don't know if the output is exactly what they were expecting. At least the government was expecting. I think there was probably some smarter people that figured consolidation was inevitable, and they started buying up every healthcare-related name they could find.
Yeah, I would agree on that. And so it's going to be interesting to see what role healthcare plays, especially in this upcoming election, whether you're Democrat or Republican. It's not really a hot-button issue on either the GOP debates or the Democratic debates, at least from what I've seen with healthcare. But I think that issue is going to come back into the spotlight in one way, shape, or form as we draw nearer to the upcoming elections.
Yeah, you know what? The immigration thing, and I guess now the terrorist thing is taking over the debate. The healthcare thing, just everybody got annoyed by it. I think their healthcare law, and I guess just from polling, they're still pretty much annoyed by it. It's just an issue they don't have to, in the primaries, they don't have to do much with it, right? For the Republicans, they just all agree they don't like it, and that's easy. So that it doesn't come up as an issue. And on the Democratic side, they can, at least it sounds like from the debates, that they just don't talk about it because it's there already. We voted it in, we won, and so right now it's a non-issue, and eventually it, especially depending on how unhappy they are, what people are with premiums, when we get to the, when you've chosen, each party's chosen a couple candidates, you'll probably see it become an issue again.
I can see that happening, yes. So anyway, moving onward, that will conclude this section of our show, the trading block, and let's move on to, and I'll say it in his format, the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the odd block.
And welcome to the Odd Block. This is the portion of our show with which Andrew is going to give his expertise on what is happening with trades that just look a little bit odd. To say the least, the smart money isn't always the big money, and the big money isn't necessarily the smart money. And that's where this is the section of the show with which we dissect such a thing. Mark, let's start off with Freeport McMoran, FCX. Down 22 cents to 803 today. It's near the bottom of its 52-week range. Paper traded 22,700. February 7-8 put spreads for 41 cents. The ADV is 72,000. Open interest is 11,000 on the 7 put, I believe that is, and 68,000, over 68,000 on the 8 put. And what are some of your thoughts on good old Freeport today?
Well, Freeport, I think this is an icon stock. I'm not sure that he started dabbling in this thing maybe at the $11, $12 range, something like that. But it's with commodity prices, they just keep selling these and selling these and selling these. And it looks like, because especially for tax losses, they just keep getting sold off till into the end of the year. So this customer, I've been watching, there's been a lot of put rolling in here. They just hold on to them for long enough, and they tend to be right. So this could be a strategy where they're long the stock, and they just keep rolling their put protection down, and hopefully at some point the stock will go back up, and they'll make a lot of money. Right now, they're probably just trying to keep the losses to a minimum, and that's what it looks like with these spreads. They're just constantly rolling puts down, and hopefully at some point they will they'll be able to make some money on them. So either they have stock against this and they're just trying to hold on, or they've done pretty well buying puts and then rolling down. So it's not the first or last put roll we're probably going to see in FCX.
Got it. So you think it's just kind of one of those things to where it's someone taking some profits on the way down in a protective put position of the long stock, or just being long puts and being the smart money?
I don't know. I'm going to say it's the former because it's kind of methodical. But, since you never know exactly what they have against it, but they just keep rolling them down. That's the thing. So it makes me feel like they want to keep taking profits, or they need to keep taking profits. They're not sitting. I mean, you're taking a Feb 8 put, and you're already rolling it to the 7 put, and you've got 4 months to go. I would think you'd have a position against that. But it's not necessarily, but on balance, I would think you'd have some kind of position against that because you wanted to keep taking profits. Because if you rip back up, now you're just into it for the Feb 7 put for small dollars. If you get back up to 12, then, or where we just were actually not long ago, you're doing well.
You are, and then there's a way with which you can be ahead even though the stock is behind, and that's the magic of doing this stuff with options. Doing stuff.
Exactly.
Imagine that.
Who thought of that? It's almost brilliant.
I've heard that somewhere before.
Exactly.
Moving onward, Chesapeake Energy. Shares are up 18 cents to $5.26 today. Chesapeake is near the lower end of the 52-week range. Paper traded today, a 5,000 by 15,000 Chesapeake January 2-5 ratio put spread. ADV is just around 68,000, and the open interest on both of these contracts is 5,600. and just under 64,000. Volume did go up in 2 blocks on the Amex, marked as a spread. There was a block of stock also going up of 200,000 shares, but was not marked with the options. A put ratio spread was buying 1 and selling 3, consistent with a short-term dip in Chesapeake. Stock block could be the upside leg, and the spread could be providing protection up to $2. With that, there's a lot of theories on this as to what it could be. I have my own, but I will give you pride of place on this because you're such a nice guy.
Well, it is the holiday season, so hopefully there's less umbrage and there's more happiness on the show.
Absolutely. We're giving up umbrage for a week, folks.
1 week only, though. That's it. So
that's right.
On plus Longo's gone, so I mean, he ultimately, where does the umbrage come from? Ultimately. Oh, wait a minute. We just said we weren't going to talk about that. All right.
Typically, he's the umbrage instigator
exactly.
of the show.
So in this particular play, it's a 1-by-3 put spread, number one. Usually, I would say a ratio like that, it could get a little exciting for somebody. But you're selling the 2-level puts in CHK, probably isn't going to be an issue, but you actually can generate some money for them. So that means you're getting into the 5 put for a very small amount. So if you buy stock and put this position on, you would be covered to $2 essentially. And if you don't think CHK is going to $2, it should work out well. I think when I saw this in the FCX, it's like it feels like kind of these bounce plays where they're buying some puts because the industry is still hurting, but they also want to try to catch one eventually, especially let's say if they're looking at it as a possible takeout or something like that, because all of these energy producers are starting to look real cheap. Last time I looked, we still use energy. However, just prices are in the basement. I think there was overproduction on almost across the board on everything, and then China slowed down a little bit. Now everybody's got to retrench, and it's pretty much destroying equity valuations in that space. So that's what I think CHK is. I think it was around 35 cents that this 1-by-3 traded for. It was a debit, so you would definitely need or be expecting at minimum a slide down somewhere. But I think the block went up concurrently. It wasn't marked, but it was 200 and something thousand shares. It looked about right as far as the deltas you needed on it.
Now, how would you do in terms of the deltas? So let's just take this back a step and say it's a 1-by-3. I own 100 shares of stock. I buy 1 put. So from there, for our listeners, you can understand how that could protect you. But what's happening is that you're protected down to $2 with that long put that you bought for a small debit. But with that, you now have, from $2 to 0, you now have not only the risk of the stock, but you also have the risk of an additional 200 shares. Now, is that something that, could you see yourself calling that a true, it's obviously not a true hedge to 0, but is that something that you would feel comfortable with if you were a stock trader in Chesapeake?
1-by-3s are not my favorite trade, but in this particular one, I think it's an asset play for somebody. So basically they'll say, yeah, I'll take the equity at $2, but they're taking it at $2 and not at $5. So, they're trying to purchase something way below the market.
Got it.
So but the good part of a trade like this is from 5 to 2, you actually are going to generate pretty substantial money. Because you think about it, if you get into the spread for small dollars, let's say it was about 40 cents, you're going to make $2.40, $2.60 to, or $1.60, I'm sorry, to $2, right? Because you're going to go from 5 to 4 to 3 to 2. I'm sorry, that's a $3 spread there, right? So if you get the trade, if you think about it this way, if you put on that spread, what's your real risk, right? If you go below $2, because you've made, you're actually clear to right around $1, right?
That's true, because the $3, let's say you make near $3, that's a good point. If you make near $3, you're risking essentially 400 shares from $2 on down, because you have the 100 shares you already own plus the other 300 that you're obligated to buy. So with that, you have the $800 with which you're obligated to, and 3 of the 800 would already be covered approximately from the profits on the put.
Right. So if you buy the put, if you're long stock, it is a partial hedge. If you're not buying any stock, you're not going to be taking it until $1 if you have to at all. So, in that case, the way it prices out, it's kind of, it's tempting, right? Or you're just covered till $2 with the put you buy. That's basically kind of what it is. And then after that, you would be a holder below $2 of an additional. You were long 1, now you'll be long 2 more. So that's how it would work. As trades go that are set up like this, it's priced out. It's pretty hard to get hurt on this one. Doesn't mean it can't happen, but
it's going to have to go pretty low.
It basically has to go bankrupt between now and January.
Yeah. But you never know.
You never know, but it could happen.
It could. Final odd blocker for today. Burlington Stores, BURL. It's near the lower end of its 52-week range. It's up 43 cents on the day, though, at 44.76. Paper traded 6,000 December 46.50 call spreads for $1.70, and 6,000 December 39 puts for $1.05. ADV is 2,300 contracts, and the open interest is 1,016 and 7,600 on the call spreads, and a whopping 29 on the puts. Volume did go up in several blocks on the Philly exchange. Total volume of the spreads went over 8,000, so the paper is most likely opening. As traded, the call spreads look buy and the puts look sell as an aggressive long play. Earnings are coming up on the 24th, so there is some risk at the 39 strike. Mr. Andrew, what thoughts have you on Burlington?
This was an interesting one. I think we covered a call buyer in Burlington not long ago. We got earnings coming out in a day or two. Somebody wants to get long this one, it feels like. I don't see really how selling stock against it would make you any money. I just didn't see where, unless it kind of stopped at 39, and even then, it seems like a lot of contracts for not a lot of money for that size of trade. So I think somebody just wants some very cheap upside. They would be into it for about a 65-cent debit, and they're looking for kind of a home run here on some retail earnings. If nothing happens, it kind of sits here. They'd kind of be out to 65 cents. That's the only problem with a trade like this for me. I don't like a risk reversal type trade unless you get a credit. I don't like them for debits, because if the thing goes nowhere, I don't want to lose money on the going to nowhere. And that, unfortunately, would be the case with this one. So it looks not bad, but I would give it a negative strike just because they're getting into it for a debit. I mean, it absolutely has to go up. So, I mean, the intent of this is pretty clear. They're looking for a big move up. There's no way around it.
Yeah, it's tough to argue with that. And then, to add to your point about doing a risk reversal for a debit, if you're going to do that, why not just buy a call?
Exactly, and not have the risk of the short put. There you go.
So that's kind of my thing for the day. Now, granted, of course, it would cost a little bit more money to buy the call, but I think there are the whole purpose as to why you would do a risk reversal is that you want the short put to finance the call. Otherwise, if the call was free, there'd be no need to have the short put. And so I guess just the point of all this is, folks, is that there's a lot of better ways to finance a short call long call if the short put is not getting it done for you in your risk reversal. So with that will conclude today's strategy block. And because it is the great week of Thanksgiving, we are going to dive right into a special Monday edition of Listener Mail.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
And welcome to the Mail Block, everybody. This is the section of our show that we all love because we get to hear from you, our favorite people in the world, because you keep the show going, our listeners. First question of the day from Topcat. I'm sorry, this one is from Vega. Appropriate name for the question that's about to be asked. Do puts and calls become more expensive ahead of events due to the risk premium? And if so, how do I avoid that in the market? Andrew, I will let you go first on this one.
The simple way is implied the volatility keeps going up. So the stock doesn't move, but the options keep increasing in price because of demand. So all the volatility expectations are much higher, and the options expand in value. So yes, they always become more expensive ahead of events due to risk premium. If so, how do you avoid that in the market? How do you avoid it? Well, we give lots of classes on how to avoid it. The easiest way really is a spread. These call spreads or a butterfly or something that gives you the kind of the movement for less dollars. So generally flies, call spreads or put spreads, something along those lines will reduce your dollar outlay. And that's really all you can do. You can be a little more clever with time spreads if you can pick up the event before it starts becoming priced in. But those are, pretty much the way, those at least I think of your choices. But ultimately, if the market knows there's an event, it's hard to avoid the premium that goes with it.
Yeah, I always kind of like to view it as a quarterback in running the 2-minute offense, and that you have to make the play call right there on the spot. But a lot of the times, the play call will be based upon what the defense is giving you. So let's just say that in theory, the defense has 11 guys crammed on the line of scrimmage, and they're all going to be blitzing right there on the spot, or that's what you believe is going to happen anyway. Then it would be foolish to just run the ball right at them. If that's the case, just dump it off to one of your receivers real quickly that the 11 men are not at. And I've always viewed option trading in a similar format, in that you just have to take what the market gives you at that specific time. And right before a big event, like what Andrew is describing, the market is giving you potential spread opportunity, and I think that's the way with which you need to look at it. Next question comes from Peter. Stocks are being hit by latency-sensitive strategies like HFT, high-frequency trading. Is that happening in options as well? Andrew, have you seen any of that in our beloved option world?
I know there is some algo strategies. The difference is the liquidity factor in options are different than in stock. So I think most of the strategies, a lot of the strategies for algos are kind of arbitrage, something like that, where they're trading one instrument and then immediately hedging in the underlying or another instrument. So net, their position's not really big. So options do trade differently than stock like that. So there's no black pools or dark pools or like big piles of liquidity somewhere for the HFT guys to sort of arbitrage. Strategies and options are generally, I'm going to do the options here and I'm going to do the stock there. Or, you put in algos that are, say, I'm a 22 volatility buyer, which I'll hedge against stock. So there's those type of things there, but because the liquidity is different than options, than stock, it's not being affected the same way. That's my simple answer on that one.
Makes a lot of sense. And that will conclude the listener mail block for today on this festive Thanksgiving week for the option block. Now we move into Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
Da-da! Okay, me being the Batman fan, that's the introduction that I wanted to have. Hopefully our editors don't cut that. With that all being said, Andrew, what are you looking forward to this week of Thanksgiving and possibly next week, in case you're not looking forward to anything this week?
Dinner.
Yes.
I'm looking for less to do this week. Watching the vol futures fell a lot today. Personally, I think that was a great thing. Worked out fine for me. I just wasn't expecting a lot of activity. I have light positions overall. Almost everything we're doing at kind of like 25% size. So it's a more quiet week. I would expect to see the vol futures maybe settle a little more. At some point, maybe Wednesday, I think options will get very, very cheap, or could be very cheap, possible for a buy setting up to the non-farm payroll number on Friday. So Wednesday will be kind of the day I'll be looking for something ultra, ultra, ultra cheap if the liquidity providers really crush the bejesus out of the options. And they're only crushing them really, too, if the paper is selling them options. And if paper is selling options, there's a lot less worry. So, I mean, you've got that non-farm number, not the non-farm payroll number, and then you have the Fed again in a couple weeks after that. And there we are. And we're close to Christmas. So the cycle between Thanksgiving and Christmas moves very fast. And, if we don't have any other unfortunate terrorism nonsense, it looks like, for whatever reason, the market is happy with the level it's at right now.
We almost went a whole show without mentioning the FED. You screwed it up here, Andrew. Come on now.
I was trying.
We almost got there, folks. Maybe next time we'll get a show without the Fed in it, but we'll get there. But yeah, I mean, there's existing home sales that came out today. We got GDP, consumer confidence, durable goods, jobless claims, new home sales, consumer sentiment. I don't think any of those are going to be ginormous market movers this week, but you never know. So with that, we are now going to conclude the program for today. But Andrew, we had mentioned everything with which you have to be thankful for. What are some things with which our listeners can be thankful for as to what's going on at the Option Pit coming up?
We have an event, I believe, in early December. Let's call it the 5th. December 5th is Saturday. We'll be doing using volatility trade direction, but the idea of this course will be trying to take as little risk as possible to generate the best possible gains for direction. So you're going to start with, the whole idea is to start with very small, near-the-money risk, but if you get the directional move you want, the position should pay well. And we're going to teach people how to use where volatility is trading, similar to that 1x3 we were just talking about in CHK, where the trader gave himself basically anywhere from $1 to infinity and beyond, I will make money if I buy a little bit of this, if I buy a little bit of stock of it. So, trying to set positions up like that, and generally it's because the market is giving you some interesting pricing with which to do that. So the whole idea is try to figure out what that pricing is. So that will be our webinar for Saturday, December 5th. Option Pit /events.
Sounds good. And for those of you that are looking for advice on your finances from someone who speaks the option lingo, feel free to contact me, your host for the day, Mike Tusaw, at 312-212-3531, or send me an email at mtusaw@rcmfs.com. That does it for our show today, folks. I am just going to be saying the same thing that I say every Thanksgiving at this time as my expert advice. Make sure that you sell your pumpkin futures, because they already should have been sold a couple of weeks ago. Make sure that you're getting ready for your Christmas tree futures. But with that, the expert advice, stay away from turkey because it has no future. On that note, I'd like to wish everybody happy Thanksgiving and have a great week. So long, everybody.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.